Welcome, everyone. I'm Sammy Azzouz, president of Heritage Financial, an independent wealth management firm based in Boston, Massachusetts. We help people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning. I'm happy to be joined today by my colleague and friend, Bob Weisse, Heritage Financial's Chief Investment Officer, for this post-summer market update. Thank you to those who submitted questions during the registration process. We'll be sure to answer them during our time today. Bob, nice to see you.
Nice to see you too, Sammy.
So Bob, walk us through what you have in terms of your thoughts on the market that's been and where we're going.
Sure. So we put some slides together today. We'll start running through with global equity valuations. As value investors and asset allocators, we keep a close eye on market valuations. And here's a slide that shows valuations across the three general regions, the way we look at the world: the US, measured by the S&P 500, developed international markets measured by the EFA, and then emerging markets. And you can see that the current PE ratio, or price to earnings ratio, for the S&P 500 is 15.8, which is exactly the 15-year average. So the average valuation there. When you go overseas, the story changes a little bit. So in the EFA, 11.7, which is lower than the historical average of 13.5. So that's showing that developed international markets are at a discount compared to their historical average, and a discount compared to the US. 74% of the US, or a 26% discount, compared to on average a 15% discount. And then when you look at emerging markets, similar to developed international, cheaper than their historical average and much cheaper than the US, a 31% discount to the US. So stepping back, you look at valuations, the story is the US is about average. Developed international markets are cheap to themselves, cheap relative to the US, and the same goes for emerging markets.
Great.
So when we look at returns year to date, we have seen a little bit of a lag recently, only by 1 or 2% with developed international markets. And that's been despite a really strong return from the US dollar. So the US dollar, measured against a basket of foreign currencies, is up 13.67%. So all else equal, this means a US dollar-based investor in non-US assets would be down 13.67, and yet the spread has only been about 1 or 2%. So this is another point. If I had a longer-term chart here, this is just year to date, but you see currencies fluctuate, and having the dollar around all-time highs is actually favorable for overseas investors if you believe in mean reversion. We put a blog out I don't know, a month ago or so, and it was cute. It was, now's the time to travel to Italy, because the dollar and euro are right around parity. $1 is 1 euro, 115, 120, $1.20 for a euro is where it's been on average over time. So unless you think that that trend's going to continue, seeing mean reversion, it makes a case from a currency standpoint, global investing.
So when you say, Bob, there was a lag of 1 to 2% compared to what?
So the U.S. equity market is on a relative basis 1 to 2% ahead of developed international markets and emerging markets.
Got it. Okay.
Then moving on from stocks to the bond market, the bond market's had a lot going on over the last year and a half. So on the bottom, we have a simple yield curve at the end of 2020. And back then, short rates were near zero. The Fed was very accommodative. Inflation was transitory. No one was worried about it. And it went out to 1.65% yield for a 30-year treasury just about a year and a half ago. And here's where we are at the end of the second quarter. You can see the 2-year treasury is up around 3%. So, and it's gone higher as we've been going through the third quarter. Now we've been closer to 3.5. So the short end of the curve is very high, and this is the market's way of saying that over the next year or two, they're expecting the Fed to continue to raise rates and get it pretty high, and then it just flattens out. So it's the market seeing rates getting to the long-term average and in the nearish term, so to speak, and that's why you have this flat curve. So when you put this together, we see equity valuations that are reasonably attractive, average to attractive, and bond yields that are higher. So part of our asset allocation process starts with looking at what we call capital market assumptions, CMAs, at the beginning of the year and building portfolios around those. If there are material moves in markets, like a big sell-off in stocks or a change in interest rates, we will rerun those. So following all the activity in markets this year, mid-year, we updated our capital market assumptions. So I won't go through every one of these, but to highlight a few, US bonds, 3.9% is our expected 20-year return, when at the beginning of the year it was 2.5. So you see a 1.4% increase in our expected return in bonds. And then going down some more, looking at equities, global equities, 8.9%. It was 8.1, so a 0.8% increase. The US market, whether it's US all cap, large cap, mid cap, small cap, in the sevens, a little higher in small and mid than all and large. And then overseas, you see international developed equity 10.1% and emerging market equity 11.4%. And that's reflective of the cheap valuations. So without getting too complicated, what's behind the scenes here is expecting some mean reversion where these markets have what they call multiple expansion as they get back to that average level, whereas the US will stay around average, and you're looking at just basically collecting the earnings yield with some growth in the US. So overall, an improvement in expected returns following the market performance we've seen this year. So the big story, the big question this year is it's about inflation. Inflation, running at 7%, 8% is what has led the Fed to be so hawkish. One of the terms people use with raising rates and talking about raising rates and economic pain, a phrase that Powell used recently. And it's been high. So the key question is inflation peaking? Has inflation peaked? Are they getting this under control? And I think there's good news on this front, and that we are seeing it slow. Two of the top contributors to inflation are energy and real estate. Real estate, they also call it shelter. Technically, and inflation is the single biggest measure. But if you look at the price of gas, it was over $5 a gallon, and it dropped over 70 days in a row to under $4 a gallon. That's a huge move in the price of gas. And gas feeds through to inflation in many ways. It's not just what people are putting in the car, but food, as an example. Food, it has to travel around the world. Energy is a component of the price. And then real estate market has been hot since COVID started, really. It took maybe a quarter or two to get it going, but I think most people have seen, their house price go up, or if they're in the market looking to buy, how competitive it's been. And there are a lot of charts we could have put in here, but one that I think is pretty straightforward. Home buyer competition dips for 6th straight month in July. So the number of houses that were in bidding wars, basically multiple offers, look at this drop off. So right away, COVID starts, and it took, like I said, by July 2020, 60% of houses for sale had multiple offers. It stayed at that 60% level steadily. And then just around April 2022, it's been falling. And other charts like mortgage applications are down, houses are staying on the market longer. So we're seeing a lot of evidence of a slowdown on the housing market. So this is good because it's showing that inflation is slowing down. So I think this is a key point and something we're keeping our eyes on. So that does get to the big question: are we headed into a recession? So the Fed is trying to slow down the economy, slow down inflation, and what some people say, try and conduct a soft landing so that inflation stops at 2%, but we do not head into recession. That's a very difficult task. Historically, more often than not, they've been in this type of situation, we do head into a recession. There are a lot of economic data points out there. But if we were to try and sum it up in one chart or one image, looking at the US LEI leading economic indicators is, I think, a good composite of the economic indicators that really tell you what's in the future. So there are 3 buckets of economic indicators. There's leading, which gives you a sense of what's going to happen, coinciding, which is what's happening now, and then lagging, which unemployment, for example, is a lagging indicator. By the time the unemployment rate's up, companies had bad profits, they had to lay people off, and that's old news by now. So there's a lot of data, but when you look at the leading indicators, you can see in this chart, the shaded bars are recessions, And you see how the leading composite starts to go down, and then the recession comes. So you're in an expansion, leading goes down, then the recession comes. And there's not too much noise in this. The COVID crash happened quickly, but you can see here it's starting to trend down. And you don't get too many head fakes to this degree without having a recession. But meanwhile, this chart shows the coincident indicator, and it's fine. This, when you put these two together, it kind of paints a bit of a concerning picture for the future, showing that things are good now, but the next 6 months out, normally leads by 6 to 7 months, picture may not be as good for the economy.
And Bob, the market itself is a leading indicator, right? The stock market, the downturns that we've been facing would plot into this chart pretty well along the blue line.
Exactly, and it is even one of the components of the leading index. I think there are 10 data points. One of the 10 is the stock market. And I think this chart shows that. So this is looking at the average S&P results versus industrial production. So looking at basically the economic cycle, with 0 being 0 months, so the peak. And the market peak, you can see, is about 7 months before. So markets will lead by about 7 months. So exactly what you were just saying, Sammy. So then what this gets to is the question of, okay, that's great that the economy may be peaking and maybe turning in the next 7 months or so, but that doesn't mean the market necessarily is peaking now. That's part of it, and we could have already seen the bottom back in June. So a lot of this could be priced in, which is why return expectations are higher than they were at the beginning of the year.
Makes sense.
So when you step back, I know some of this, like looking at the LEI data in particular, is concerning. But we do believe stocks favor long-term investors. And when you just step back and look at returns going back to 1926, you see these long stretches where you make a lot of money in stocks, followed by the declines, the bear markets. And when you look at this, it does get to, don't try and time the markets. To try and get in right after the dip and then get out, get in. You just don't want to do that well. So the way I look at it is step back, and if you're an accumulator, when markets are down like this, now's the time you got to be adding. You should be adding when you have extra cash, when it's time to invest, and don't let a down market be the reason to hold back cash. If you're living off your portfolio and withdrawing, this is why you're diversified. Mm-hmm. You should have real assets, alternative investments, short-term bonds. And if you have those have been places that have held up well this year, and that's where you drop money for your living expenses. So you can stomach volatility, and this too shall pass. So that's just how we look at it from a stock market investing standpoint. And then a piece of good news is in bonds with yields rising. I talked about how our returns are higher. So here you see the net yield to maturity of the Heritage fixed income portfolio, 4.33, much higher than it was at the beginning of the year, compared to the bond index, which is 3.69. So you're looking at about a 0.64% yield premium. We do take a little more credit risk. Our average credit quality is single A, investment grade, but not triple A, because this is mostly treasuries, but less interest rate risk, a duration 4 versus 6.44. So we're quite a bit less sensitive to changes in interest rates. So if rates go up, our portfolios will hold up better than the overall bond market while still getting a nice yield. And the last slide I think we have here for today gets to what I said a minute ago about having a place to rebalance and draw from. Private credit, an area that our clients are invested in, it's up 4.79%. And then another area of real assets up 4.41. So this gets to diversification, asset allocation, having these 4 different pillars helps the portfolio. So you always have some place to look to when in an unusual year when both global stocks and US bonds are down. So, but that's a quick update for today. Sammy, anything we didn't cover that you want to go over more?
No, I don't think so. I mean, I think it was a very thorough overview about how we're currently positioned and why and what we've been seeing in the market. And basically, there is bad news out there just in terms of the inflation numbers, or there has been, and the Fed having to raise rates to combat that. And we've seen the market sell off. and we've seen increased volatility. And you're laying out a case that, we don't know when that will be over, but at some point, some of that gets priced in, and your future return expectations should be stronger because of, both the stock market sell-offs and yields being higher on bonds. And then you've kind of put the analysis and the thoughts behind it so people understand why you feel that way and why we're positioned the way that we are. So I think it was a great overview, Bob. It explains a lot about what your team is looking into. Anything in terms of your outlook or changes to portfolios that you'd be considering beyond, the additional return expectations that you've seen in the stock and the bond market because of the market dislocation we've had this year?
The only thing I'd add is just we are getting, you could say, excited about the bond market. It's not too often that you see the bond market go down 10%. And typically when you see asset classes move, and relative to the volatility in the bond market with such a big move on the downside, it's cheap. So we're slightly building up our bond allocation, taking advantage of the higher yields that markets are offering us now. But no big changes, rebalancing, taking profits from those areas that have done well is a theme that we've had throughout the year.
Thank you, everyone, for joining us today. There's a lot of uncertainty out there. Heritage has a very proactive, diversified investment strategy, some of which you heard from Bob today, taking you under the hood and behind the scenes. If you are not a Heritage client and you're curious about how your portfolio is positioned today relative to everything that's going on and what we discussed, please don't hesitate to reach out to us. If you are a Heritage client and have any additional questions, please don't hesitate to reach out to your wealth management team. For more timely insights, visit our website, heritagefinancial.net, to easily subscribe to our weekly blog, the Wealthy Behavior Podcast, and be sure to follow Heritage Financial on LinkedIn, Facebook, and Twitter. Thanks for listening.